Hi everyone, my name is Robin Speziale and I'm the national best-selling author of a book called Market Masters. You can pick up Market Masters at your local bookstore, library, or online at amazon.com or amazon.ca. So today in this video I'll be talking about what to do in a stock market crash. And a lot of people talk about the future, and you'll see a lot of forecasts online like on CNBC or BNN. I do get some questions as well. A question might be, hey Robin, do you think this is the peak of the market? Like, really, I have no idea. I ignore all the forecasts and I just stick to picking stocks, in up and down markets. And I'll give you a story though about what I did in the 2008 financial crisis when I think the S&P 500, it was down close to 50%, and even if you look at the TSX Composite Index, huge drawdowns, right, around the world and every single major market. And in 2008 through 2009, I think the nadir, the bottom out of that market fallout was March 2009. I didn't sell any of my stocks, and what I did, I just started to buy more. And what someone like, actually, this is what Warren Buffett said. I think something along the lines of, once you start hearing the robins chirping, spring is already like well into the season. And so what he was trying to say is that always be taking advantage of crashes, of downturns. When stocks are slashed in half, like what we saw with big companies like Royal Bank of Canada and with American Express and with a lot of blue chip stocks. It wasn't just the small cap and mid cap and micro cap, quote unquote risky stocks. It was big companies that they weren't going to be going bankrupt. All these companies just were slashed in half, between 30% and 50% drawdowns in their market caps. And again, I was just buying more of these great businesses, and that's how I reacted in a market crash, specifically the financial crisis of 2008. I was too young to be investing through the technology bubble, but again, I would just probably be trying to pick the best companies at that time, where their stocks were on sale. And if there is a crash, who knows, in the next couple of years I'll be doing the same thing. I'll just be buying more companies that I've been investing in for years, that I have a good fundamental thesis on. I'll just be buying them at cheaper valuations. And I think this is the best way to compound your money over time. And I've always told people that excuse me, like you really should be wishing for a downturn, not a drastic downturn, but corrections are always healthy. And a downturn like a 50% drawdown in the stock market that systemically knocks most stocks down is just one of the best gifts that can ever be presented to an investor during their career. And I expect during my investing career, I've already experienced that one, close to 50% drawdown. Perhaps I'll experience between 3 and 5, more of these by the time I'm, let's say, 80. I'm just throwing that out there. But again, like, it really is a gift to investors to be able to buy great companies at cheaper valuations, and it just helps that much more in compounding your capital, compounding your portfolio over time. And one of the ways that I help myself is early on I read a lot of books on behavioral finance, and there's a lot of truth to that. It's not only intelligence. Like, intelligence in picking the right stocks can only take you so far. Like, imagine picking Amazon when it IPO'd, and I think it was 1997. You could have been a genius to buy it then, but then it takes a different type of, let's say, like emotional intelligence to actually hold the stock like Amazon through the ups and downs, through these 50, 75% plus drawdowns in a stock like that over time. And so it's really intelligence, combined with conviction and combined with a vision for the different companies that you're picking on the stock market that really determine the amazing investors from the ones that have mediocre to poor returns in the stock market. And there are some more studies. You can look this up on Google, which talks about like timing the market versus time in the market. And it's very tough to be able to buy at the immediate bottoms of the market and then sell at the immediate top. Like that really is a fool's game. But really it's time in the market that determines success for the do-it-yourself investor. So I hope this did help. I'm not recommending that you buy or sell now. I have no idea what the future holds for us. This is mid-year now, 2018. Who really knows how long this market can hold up? But in my opinion, as long as you don't have these black swans or any systemic risk that does hit the market, like in 2008 it was the housing crisis, and that was just a credit balloon that just popped. In 2000 and 2001 it was that tech bubble pop where you had technology companies with obscene valuations pop, and today you don't see that with technology companies. The big FANG stocks have so much cash on hand. But who really knows what might pop the market in the future? My philosophy has always been to follow corporate earnings, and as long as if you look at the S&P 500 or the TSX 60, the biggest companies that are trading in North America, as long as you see quarter after quarter, year after year, as long as you see earnings hold up and earnings growing consistently, really earnings will push stock prices higher, and that's what I look for. It's really the fundamental type of analysis that I do conduct. So I hope this video helped, guys. If you have any questions, you can email me at r.speziale@gmail.com and visit my site and my blog at robinspeziale.com. Talk soon and happy investing. Bye.